It's European Inflation Day, so we're going to have a look at the numbers coming out, the expected, the previous, etc., and see whether it means that the euro is doomed and if the ECB are in a bit of a tricky spot. Then we're going to move over to Canada, as we discussed yesterday, because it's their CPI data. Their PPI data came out stronger yesterday. What does this mean for Canadian interest rates? And then we're going to look in our trade and takeout today at why you really need to pay attention to equities earnings. So in front of me, I have the European inflation data. You can see here, this is the key one, 5.3% expected. I think we're coming a little bit softer, maybe 5.2% or in line, which is also soft in my view, after the ECB's hike. Interestingly, as I said yesterday, on Friday, or Thursday or Friday actually, the market had priced in rate cuts into June next year rather than September. So rate cuts have been brought forward. So this is where I'm thinking that there's some slight disinflationary pressures now. We're getting to the stage where, the market's expecting a little dovishness next year. And it's also one of the reasons why I highlighted the Canadian dollar yesterday versus the euro. I personally think that from that trade, it's dependent on what happens later on in the afternoon, because we have the Canadian numbers, which I'm going to get into. But my view is that the euro is relatively weak now. And we're on a very continued path. I'm just going to switch over here. We're on a continued path to the downside in terms of the euro. And we've chosen just yesterday to have a look at EuroCAD to explore this, purely because, we've got this purely ECB hiking regime that caused the rally up. And now we're seeing that tail off. We've seen it tail off throughout 2023. Very indicative, very, very indicative. Everything got normalized here. Seen the 200 weekly moving average as well, smashed through. So likely there's some follow through these kind of levels. But we're going to pay attention to that more over the coming weeks, because I think there's really something there in terms of a thematic view on the market. But core of it is that the euro is weak. We'll explore it through the euro dollar as well. You can see now we've tickled well below 1.07 on euro USD. Here's the 200 weekly again up there, big 15-year trend line. You know the story here. It's not looking great, but always key with the euro is to look at the cycles. So here we had the sovereign debt crisis. Draghi stepped in, caused the euro to rally, didn't breach the prior high. 2008 high, didn't breach it either, even after QE, normalized things. Again, no breach of the prior high. We're seeing it again. There's no breach of this prior high up at 1.2 that was back in 2021. Same thing every single time. There's never a breach of the prior high, and it just tucks below this long-term trend line. If you look at things from a probability perspective, I've said it previously, this is maybe where the key level is, 0.95, and it is it's terrifying, but it makes sense. If the Eurozone wants to stimulate demand, they're probably going to need a weaker euro, especially against China as well. So this is where we're looking at things, euro weak, disinflationary pressures, and more specifically, more disinflationary than other economies. So moving on to Canada, and today we've got Canadian CPI. Yesterday we had their PPI. Their PPI, I recorded the video yesterday before the number came out, ended up being higher than expected and came out at 1.3%. Now, CPI is very, very closely tied to PPI, Producer Price Index. And the expectation currently is that CPI inflation will be at 3.8%. The previous was 3.3%. So there is an inflationary pressure there. You're seeing an increase on the year-on-year number, month to month, if that makes sense. With the recent uptick in PPI, I'm expecting this to be actually probably at about 4%. That's my bet. And I'm thinking that, we're playing off the two differentials here. We're playing off the two interest rate expectation differentials. So we've got the Eurozone which is looking like it's got some deflationary pressures, or disinflationary pressures. And then we've got Canada, which looks like it's got some inflationary pressures. We can see that just by looking at the previous data point of 3.3% and the expected of 3.8%. I'll be very, very surprised if it's not a beat to the upside. I'll be very surprised if it's not higher than 3.8%, to be honest with you. And so, you know, I've just gone through the Eurozone data points in terms of inflation, and we've looked at EuroCAD already, but it's important to look at a chart of the month-on-month producer price inflation, because look at this uptick. You know, from in July's number, it was about 0%. I think it was just sub. It was just sub 0%, so negative. Now it's shot up to 1.3%. That's quite the change, and I think this is all influenced because of the oil price uptick throughout August. I think that's what it is. And so we can start adding in the probabilities of, okay, what's going on here? You know, what is the actual cause of this, and how can I actually trade off of it? Is it more likely that the euro is going to strengthen from here, or is it more likely that the Canadian dollar is going to strengthen from here? Is it more likely that the Canadian dollar is going to weaken from here, or, you know, vice versa? So these are the arguments that you have to have in your head all the time when you're looking at the macro side of things. And I really, really like this setup here for a disinflationary effect in the Eurozone versus a more of an inflationary effect in Canada. And now on to today's trading takeout, which is why you need to pay attention to stock earnings. TUI, which is a British travel agent and also a airliner, they've come out today and said that their summer 2023 is absolutely excellent. And they're looking to fulfill their full year guidance, which means they're basically looking to achieve the profit and revenue that they expected to achieve at the start of the year. Now, what does this mean amongst all of the doom and gloom? I thought people couldn't afford things. I thought people couldn't go on holiday. So what is going on? Well, this is when you kind of have to stop paying attention to the front pages and really, really look at the numbers. You know, if a travel agent and an airliner is able to, you know, achieve the profit targets that they set amongst all of this sort of rubbish going on, all of this high inflation, high costs, all of this, how did they do it? It's not fake money. People are actually going out and spending it. Even just earlier this year, Gatwick Airport had the highest footfall ever. So what's going on if people's pockets are that squeezed? Well, I think there's still a long and broad hangover from the pandemic where people haven't necessarily spent all of their savings. They're still experiencing that wage growth. And, you know, perhaps they're cutting back and things like that. But I guess at the end of the day, we still haven't seen the full effects of these interest rate rises. Things are more expensive, absolutely. But at the same time, we're not seeing the mass defaults, the mass bankruptcies, et cetera, that we would probably perceive, or, you know, that happened during 2007, 2008. So the moral of the story is look at the fundamentals when you're looking to action a thematic trade, because the fundamentals of and nuances in single stocks matter a hell of a lot for the bigger picture.